Hello and welcome to the weekly market metrics. I'm your host Sandeep and we are in week 4 of 2026. We're just 3 weeks into 2026 and this week saw a complete mayhem in the equity markets, except of course for precious metals and commodities. And that's why I got curious about what's happening in equity markets. Is there any index that is positive? So here's what I did. I looked at all indexes. That is market cap weighted indexes, sectoral indexes, factor based indexes, you name it, to see if any of it is in green. Let's start with market cap weighted indexes. Nifty total market or Nifty 750 is down about 6% from its 52-week high. Nifty microcap 250 is the worst hit, down nearly 17%, followed by small cap 250. Mid-cap 150 has been relatively stable, down just about 7%, while Nifty 50 has corrected the least at about 5%. This clearly shows that small and micro caps have taken the maximum hit, while the large caps, especially Nifty 100 and Nifty 50, are holding up relatively well with a drawdown of close to 5%. Now let's look at sectoral indexes. Looking at the sectoral index drawdowns from 52-week highs, the maximum damage is in high beta sectors. Nifty Realty and Media are worst hit, down over 25%, followed by tourism and defense with close to 20% corrections. Consumer durables, IT and FMCG are down in low to mid-teens. On the other hand, defensives and financials remain relatively resilient. Pharma, financial services, banks and metals have seen limited drawdowns, mostly under 5%. Moving on to factor indices, the maximum drawdowns are again visible in the small cap and high beta strategies. Small cap quality and momentum based indices are down 16 to 17%, while mid and small cap momentum quality indices are down in low double digits. Alpha and pure value momentum strategies have corrected around 8 to 12%. On the defensive side, low volatility value and quality value low volatility factors have held up relatively well, with drawdowns largely limited to 3 to 5%. Nifty 50 Value 20 remains the most resilient index, which is down just about 2.5%. Now that's how bad things are. There's not a single index in green. Anyways, let's check the charts and see how the price action played out this week. We will also look at what is possible in the coming week. As always, Nifty first. After forming a doji on the weekly chart last week, Nifty extended its downtrend this week, falling 2.51% or 646 points. This marks Nifty's largest absolute weekly close-to-close move, up or down in the last 17 weeks. The last time we saw a similar move was in the final week of September 2025, when Nifty declined 2.65%, and just in 4 months we again have such high volatility. This week Nifty closed at 25,048 after making a low of 24,920 during the week. The weekly range stood at 733 points or 2.86%. Notably, the weekly open was equal to the high, indicating a clear bearish bias. Despite the weakness, Nifty continues to hold the 25,000 level on a closing basis. The key question now is whether we will see a bounce from here or a deeper correction in the pre-budget week. My view is that Nifty is likely to remain range-bound until the budget is presented, after which a clear directional move could emerge on either side. On the upside, this week's high of 25,650 acts as a resistance. Immediate support is placed at 24,900, followed by 24,600 and 24,350. Moving on to the daily time frame, Nifty printed 4 red candles and 1 green candle. Out of the 4 red sessions, 2 were nearly 1% down days, highlighting the elevated volatility. There is visible buying interest in the 24,900-25,000 zone, and the index has managed to close about 25,000. This big round number now acts as a key psychological support. The remaining support and resistance levels remain unchanged from the weekly chart. On the upside, resistance stands at 25,650, while immediate support is at 24,900, followed by 24,600. Moving on to Nifty on an hourly time frame, it continues to trade below the 50 EMA. We have now seen a clean short-term trend for nearly 2 weeks, and it has been firmly on the downside. But let me not jinx it for the trend followers. Now let's talk about Nifty's expected range into the upcoming monthly expiry on Tuesday, 27 January. Based on the options data, the ATM straddle closed at around 215 points. This is Nifty's 1 DTE premium, with Monday being a holiday due to Republic Day. A long weekend, ongoing geopolitical uncertainty and upcoming union budget, and the ever-pending India-US trade deal have all contributed to elevated risk and therefore elevated premiums. This is clearly reflected in the high straddle premium that you're seeing. With Nifty spot closing near 25,049, the implied expiry range stands at, on the upside, 25,264 and on the downside 24,834. This translates to an implied move of roughly 0.86% on either side. Looking at the open interest data, on the call side, the 25,500 and 25,300 strikes carry the highest open interest. On the put side, open interest remains weaker compared to calls. The 25,000 puts saw unwinding through Friday's session but still holds the highest open interest on the put side. Given the current high volatility, it is difficult to clearly gauge support or resistance levels using open interest data. And with that, let me wrap the OI analysis for this week. Moving on to SENSEX, on the weekly time frame, similar to Nifty, SENSEX also resumed its downtrend move after last week's pause. SENSEX fell another 2,032 points or 2.43% this week to close at 81,537. It has broken all the support levels discussed last week. The next key weekly supports are now placed at 80,400 and 79,800. The bias remains bearish unless SENSEX manages a close above the week's high of 83,540, which now acts as a resistance. On the daily time frame, this week's high at 83,550 and low at 81,100 remain the immediate resistance and support levels. The structure remains in a clear downtrend, with the index continuing to form lower highs and lower lows on the daily chart. Moving on to the expected range for SENSEX till its expiry. Now, the next SENSEX expiry falls on Thursday, 29 January 2026, and it is a monthly expiry. With just 3 days to expiry, the ATM straddle closed in 4 digits at 1,067, marking a sharp increase in volatility compared to previous weeks. Based on this pricing, the implied expiry range comes to, on the upside 82,605 and on the downside 84,471. This broadly places SENSEX in an 82,600 to 80,500 range. This is the last expiry before the budget, so elevated premiums are expected. However, this premium is likely to melt ahead of the actual event. While this presents opportunities in both Nifty and SENSEX from an option premium perspective, the risk remains high. Do let me know in the comments what strategies you plan to use to harvest premium this time around. Moving on to BANKNIFTY on a weekly time frame, after holding up for several weeks, BANKNIFTY finally gave up this week, falling 2.7% or 1,622 points to close at 58,473. This marks the highest absolute weekly move in the last 20 weeks. The previous one was in the last week of August 2025. The index also came close to forming an open equals high candle, highlighting strong selling pressure. Resistance is placed at this week's high of 60,100, while support is seen near 57,700. This creates a very wide trading range of around 2,400 points, driven by the recent surge in volatility and range expansion. On the daily time frame, BANKNIFTY printed 4 red candles and 1 green candle this week. The immediate support to watch is the recent low at 58,276. If this level breaks, the next support comes in around 57,400. On the upside, resistance remains at 59,600, followed by 60,100. On the hourly time frame, unlike Nifty, BANKNIFTY is chopping around the 50 MA and not offering a smooth downtrend. Hourly candle ranges remain wild, making it difficult for short-term trend followers. Trend following in sectoral indices like BANKNIFTY is generally harder compared to broader indexes like Nifty. However, when BANKNIFTY does trend, the rewards can be significant. Moving on to rate of change, in the fourth week of 2026, it was deep red across indexes. Nifty, SENSEX and BANKNIFTY all fell over 2.5%, while mid-cap Nifty underperformed by closing down 4.61%. January is historically a negative month, but this year it's turning out to be no different. Moving to the top performing sectors this week, or rather the sectors that fell the least. FMCG declined the least at 0.92%, followed by metals, CPSC, IT and pharma. Metal and IT continue from last week, while the other three are new entrants this week. The presence of defensive sectors during a market decline reflects classic market behavior. Talking about range and expiries, this week saw a 15% expansion in range compared to last week, with the 5-day average daily range rising to 309 points from 271. Weekly ranges also expanded across indexes. Wednesday recorded the highest daily range of BANKNIFTY and SENSEX, while Tuesday saw the highest range for Nifty and mid-cap Nifty. Let's talk about SENSEX expiry first. Just look at the wild intraday swings on this 5-minute chart. Plus 400, minus 867, plus 345, minus 385, then plus 563. Absolute insane volatility. Easily one of the toughest trading days in many months. What hurt option writers the most was the combination of sharp moves and elevated premiums, leading to large absolute losses. This is exactly why stop losses should be managed at portfolio level and not just based on individual option premiums. Nifty expiry, on the other hand, was relatively easier as it offered a clean directional move. However, coming straight from a low volatility environment, the same strategies and risk management approaches don't work anymore. Different market regimes demand different strategies. That said, it's all easier said than done, and everything looks perfect in hindsight. With 2 monthly expiries lined up next week, amid heightened uncertainty, it's going to be anything but easy. Let's see what the market has in store. Talking about the volatility index, India VIX, it surged 25% this week to close at 14.19. With the coming week being the pre-budget, key question is, where is VIX headed next? My view is that VIX could move toward the 17-18 zone before cooling off after the budget announcement. Moving on to commodities this week, what a week this was. If you thought equities were volatile this week, commodities took it to another level. Gold surged 10%, silver jumped 16%, and natural gas exploded 65% in a single week. Yes, 65%. On a year-to-date basis, silver is already up 41% in less than a month, while gold is up 16%. In both gold and silver, we saw extremely sharp ranges of around 10 and 18% on Thursday, despite USD prices not falling to the same extent. Some people speculate that this could be due to MTF positions being built in these ETFs. Let me know what you think. In summary, the markets largely remained bearish this week, with Nifty, SENSEX and all other indexes closing in red. Volatility obviously has picked up both due to geopolitical tensions and the upcoming budget. Sector performance was weak, with metal and FMCG managing to hold up a bit. Overall, the market tone is bearish with rising volatility. They used to say Januaries are tough, but I didn't expect it to be this tough. Moving on to what caught my attention this week, one, I came across this interesting article on when to sell. Given this mad rally in precious metals, especially in gold and silver, a friend of mine asked me if he should sell out. I pointed him to this article. 2, I have been following this whole prediction market space in the US for a while, and last week I read this interesting NYT piece titled "Betting on Prediction Markets is Their Job and They Make Millions." It talks about how the winners devise strategies to make better predictions, and also touches on the fact that since these markets are not regulated, there is a possibility of insider trading as well. Lastly, how can I not share this Guardian piece on Greenland's sovereignty issue? It talks about why Trump is interested in Greenland after all. All links are in the video description. Now over to what to expect in the coming week. Well, next week is a 4-day trading week thanks to Monday being a holiday on the eve of the Republic Day. There are no events lined up during the week, but we have a union budget on the 1st of Feb, which is a Sunday and a working day. Volatility may continue to rise up to the budget day, as I had shared in my previous budget day strategy video. Talking about the markets, the overall sentiment remains bearish, but given that we've been down for a couple of weeks, I do expect some bounce from these levels. Commodities are still not showing any signs of slowing, so that may continue as is. And with that, we wrap this week's Market Metrics. If you find the series useful, don't forget to subscribe to the channel. Until then, stay curious, stay steady, and enjoy your weekend.